Hi, well, welcome to part 8 of my Rivian deep dive. So we stopped at looking at automotive cost of revenue. Now we wanted to dive into some of the more interesting bits. On this chart, you see the average vehicle production cost assumption by main product category or platform, as it's quoted here, stated here. And so this is shown in thousands of US dollar. And when we look at Q4, Rivian's average production cost for the R1 and van platforms is $99,000. And I just want to point out why this is combined in this analysis. So fundamentally, it makes not much sense to combine the R1 platform, which comprises the truck and the SUV, which are also higher end vehicles with almost $90,000 average vehicle selling prices, with the van, which is a Amazon delivery vehicle, which I mean there are vans, quite pricey vans, but still completely different categories of vehicle. The only reason why I combine this, because management always shares numbers, or most of the time, that combine these two, and to make forecasting vastly easier and to avoid making assumptions on assumptions on yet these assumptions again, it's just better to just lump them together and model them as once. So with that out of the way, if we look at the development of the R1 van platforms, average production cost development, you can see that the forecast assumes, let's call it a consistent, at least around about $2,000 sequential cost takeout, which is ambitious, but certainly achievable, especially given Rivian's guidance of commodities tailwind. But what limits progress is that the volume is not increasing in 2025, plus might actually decrease, but we'll discuss it later. And this forecast is probably quite realistic, where it gets increasingly perhaps too optimistic as we move into 2026. And the reason is, it sounds to me that RJ, once the R2 launches, is keen on maintaining the R1 and the R1 truck and SUV more as kind of the premium end of the brand. He called it like the handshake to the brand, I think was the wording he used. And it makes kind of sense of having this more premium, to have something aspirational for people who are new to the brand. But there's a lot of marketing stuff I'm not going to go into here in much detail. The bottom line is, because they will keep it premium, I'm not sure how much they can bring down production cost on realistically, because that would at some point mean to remove some of the bells and whistles from the vehicles, which I think that clientele loves dearly. Then you look at 2026, and we see the launch of the R2 platform. And keep in mind, the R2 is like, in terms of vehicle category, comparable to the Model Y, size-wise, etc. And you see here quite a high production cost initially. This is completely normal, because in the beginning you have very, very low production volume, but it's quite common that automakers in the US depreciate production tooling, machinery, etc. on a straight line. So the depreciation charge is actually not driven by volume, as it is often in under IFRS accounting, for example, in European automakers. And that's why the depreciation charge is huge when you have very small volumes, and that just drives the cost up significantly. And then there are other similar effects when you have very small volume. Plus, of course, all your operators, they're not skilled yet in putting the vehicle together. It takes them a little longer than once they did 10,000 of these units, they can put together the vehicle blind. Plus, in the beginning of times, there's always fine-tuning of the production lines. There are always issues you need to solve, etc. So you have always kind of this ramp curve. Even the best automakers take typically at least a couple of quarters before they dial everything in. Then industry-wide, on a new production line, I need to point out, on a new production line, a new vehicle, which is the case here, if you can make the vehicle if you can achieve gross profits within 3 quarters, you're doing actually quite well. And this is the underlying assumption in the modeling that you see here. So basically, this production cost at the end of the 3rd quarter, after the R2 launch, lines up with um, the volume weighted average price of the trims that Rivian is going to sell in that quarter. And on this slide, we put this into perspective. On this slide, we look at the gross margin by product platform. So the R2, I optimistically assume they have a negative gross margin in the very beginning, which is quite optimistic. Often it can cost twice as much to make one vehicle than what it can sell for in the very beginning because of the effects I mentioned earlier. I expect a significant sequential improvement, and then to hit this magical break-even point where they actually don't lose money anymore on selling these vehicles as volume ramps, and then it keeps ramping. And you see in the curve here this little drop in, let's call it velocity, and or the first derivative is decreasing, and the reason for that is the seasonality effect. 1Q, because of winter, etc., tends to see slowing in progress, and the forecast tries to account for that. And just real quick on the R1 and Vans platform, you can see that in 4Q 2024, the margin that was reported was 15.5% negative. And the forecast projects a sequential further decrease to 19.3%, and the reason is driven by a significant decrease in sequential volume as Rivian guided to, because yet again, when the volume drops, your depreciation and some other charges spike up on a per vehicle unit basis, and that's why you see this temporary slowdown in improvement. But then the forecast continues with sort of an optimistic development. Again, this is based on a optimistic price assumption and a continuous cost improvement for the R1 and van platforms to achieve a gross profit before credits and anything else sometime mid 2026, and you can see here the number for the third quarter 2026 would be 0.5% based on the assumption of the forecast. Of course, the real number will not be exactly that number. That would be quite amazing, but this gives you ballpark sort of a sense of what I often call the opportunity space. Opportunity space, I think, for the R1 van platform is quite limited. And also when you look at the opportunity space for the R2 platform, the forecast projects the vehicle gets to a 22% gross margin, basically end of the second year, so in 2027. So let's talk about it for a second. That is a very high gross margin, and sort of the Rivian bulls might say, oh, but Tesla touched 30% as the Model Y was ramping up. But they completely forget one thing. When Tesla ramped the Model Y, there was no other Tesla in the market. Rivian has to compete against Tesla. But when Tesla launched or scaled the Models Y, there were also some other one-off effects. For example, COVID was a significant margin booster, and I'm not going to get into detail why, because this video would become way too long. Rivian probably not going to see another kind of COVID effect. Plus, of course, there are now lots of other, at least to certain customers, comparable or competitive alternatives in the market. There was a huge influx of other electric SUVs. So, so this was a long-winded way of saying that the competitive environment, once, keep in mind, the R2 hits in scaled in basically 3 years from now to a major volume, faces a completely changed competitive environment compared to when Tesla managed to deliver with the Model Y very high gross margins. So I think, to be honest, it's completely unrealistic that Rivian can achieve anything more than what you see on this chart right now, given this change in competition. On top of that, Rivian simply doesn't have the money to make anything competitive in autonomy, so this also limits in various ways. So I think the forecast with this gross margin projection is actually very aggressive or highly optimistic, and also something to keep in mind. So with that, I will wrap up part 8 of this series and hope to see you next one. Thank you for listening. Bye.